Welcome back. We're going to complete Chapter 18, and we're going to focus on the circular flow of income in an economy, the national income identity. We're going to kind of look at how money flows through an economy with an equation, and then we're going to focus on how real GDP kind of misses the point when we're measuring certain types of economic welfare and what other measures of economic welfare there might actually be. Now, let's remember where we started Chapter 18 with. Macroeconomics studies the economy in aggregate, everything that's happening. And essentially, we care about economic activity in that economy, which is all the goods and services produced for sale. And we also remembered, we've learned a lot about this thing called GDP, which is the same as saying it's the total income of an economy, or the same as saying it's the total production of an economy, which is the same as saying it's the total household spending in an economy. Essentially, we follow the money. Household spending is linked to household income in this way. Households get income because workers in the household sell their labor to firms and they receive a wage. What do households do with that income or that wage? Well, they can spend it or they can save it. Guess what? Households are also responsible, technically speaking, for owning all the firms in an economy. Now, how is that, you ask? Well, if you've ever tried to follow the stock market, you know that by owning a share of stock in a company, you're actually a part owner of the company itself. And who owns shares of stock? Well, it's people. And where do we find people? In the households. So essentially, households in an economy own the firms and they buy and sell from the firms. Let's look at a really simplistic picture of that. In this picture, we see that there are two entities in the economy. There are firms and there are households. Firms take the labor from workers in the households and give them wages, and households take those wages and they spend money on the goods and services of the firms. Now, in a nice balanced economy, I assume that if all the households in the economy receive approximately 300 billion pesos worth, because we're going to talk about Argentina again, 300 billion pesos worth of wages, then they spend 300 billion pesos worth on stuff from the firms. Now, let's just look at it the other way. That's the buying and the money direction, but in this case, we're going to look at it from the opposite direction. Households sell $300 billion worth of labor, or 300 billion pesos worth of labor, and firms sell 300 billion pesos worth of a good or service. In this case, for fun's sake, we said all the goods and services in the economy were made up of pizza. So, once again, looking at it from a buying perspective, firms buy labor and send 300 billion pesos worth of wages to the households. Households buy goods, say pizza, and they send 300 billion pesos to the firms. On the selling aspect, households sell labor and firms sell goods and services, aka pizza. Now let's look at how it all balances out on the household level and the firm level. Notice that because there's 300 billion pesos worth of GDP in this economy, so we have to have it all balanced somehow. Firms have to pay wages, that's payment for inputs, but they receive revenues, okay? Well, where do firms receive those revenues from? They receive it from households. And why do households send revenues to the firms? Well, because they are consuming. We just said that the firms pay for the labor input in the form of wages. And that is the income that households receive, and it must equal what they spend. They can't spend more than they bring in, right? I know, you're thinking of credit cards, but even in that, they still have to pay off their credit cards, right? Legally speaking. So really, a household can only spend what it brings in, and a firm can only pay to its inputs what it brings in revenues. Now let's break that down a little bit. There's a few things we've just learned. Overall spending in the economy by the households will end up equaling the total amount of production that is made in the economy. Because households spend money, which creates inflows of cash to the firms, which we call revenues. And revenues to the firms are used to produce goods, which is then the total production of the economy. Number 2, the total production in the economy is going to equal the total payments to the inputs. Remember, because as the firm is making 300 billion pesos worth of goods, they can only spend on inputs what they're bringing in. So revenues come into the firms and go out of the firms to pay for labor or capital or something else. But in our very simple example, the only input is labor. Now, the payments to the inputs, in this case, we're talking about wages going to workers, that has to equal the total income of all households. Because the only way households get income, at least in our very simple example, is to get it by working, by selling their labor. The total of all that is the total of all the income in the economy. And lastly, all of the income in every household cannot be greater than its total spending. And we assume, for purposes of our example, that households spend all of their income, which means all of the household incomes in all of the economy will equal all of the spending in all of the economy. Once again, let's look at it in terms of that nice little equation. Gross domestic product is going to be equal to the total national income, which is equal to the total spending in the economy, which is equal to the total production. Now, let's get a little more complicated. Notice, we now have some other actors. We did have just households and firms previously. But now we're going to add in the government in the economy. Notice, households have to pay taxes to the government. So do firms. Part of what firms pay out is not just wages to the workers. They also have to take some of their income, some of their revenue, and they have to give it to the government in the form of taxes. But the government also gives things. It sends what we call transfers to households. Transfers are like government benefits. It's like getting welfare or maybe some health care or even in the form of roads and garbage collection for some people. So that's what we call transfers. Those are benefits that households receive from the government. Firms also receive benefit from the government in the form of government purchases, because the government buys stuff, right? It buys planes, it buys pencils, it buys paper, and it buys it from the firms in the economy. So that's how we fit the government in. Now, remember we were saying initially that all of the income to households was somehow turned immediately into spending? But earlier on we said households don't just spend, they also save, right? Well, when they save, they send their money to banks, which we're going to call financial institutions here. What do financial institutions do with all of that savings that the households are sending to them? Well, they loan to the government, because it turns out a lot of times governments actually don't bring in enough in taxes to cover all of their government purchases, so governments borrow. Financial institutions also still have money left over, so what do? They invest in firms so that firms can grow and produce more goods. Now, the rest of the money that isn't saved, the households do use for purchases, for consumption. But do households only purchase from firms in their own economy? No, they don't. They also purchase from other economies, right? Where do most of your toys come from and your clothes? Probably China, Vietnam, Malaysia, right? We call those imports. Household consumption is not just from the firms in its own economy. It's also from the rest of the world, the foreign areas. Now, however, the rest of the world is sending exports into our economy, and our own firms are sending exports into the rest of the world, right? In addition, sometimes our financial institutions don't just get money from the households in the economy, in its own economy, they also get money from the rest of the world. Now that seems confusing, right? We just talked about a lot of things. Let's break that down. And the way we break that down is into something called the national income identity. It's just a formula that tries to identify all the ways that we can find production, or otherwise said income, remember, because production and income should be equal in an economy. What are the ways we can break it down? Well, we break it down into household consumption, total investment, government purchases, and then net exports. And we're going to break each one of those things down now. Let's look at the firm from the firm's perspective first in the economy. Consumption, firms produce enough to deal with the consumption demand in the economy, which is the total expenditures by households on final goods and services. Firms also can produce more because of investment. which is them purchasing goods and services that help produce more output in the future. Firms also produce enough to account for all the government purchases, which are all the purchases of final goods and services by a national government. And lastly, firms produce enough to cover all the net exports. Now, whenever you see the word net in business or in economics, what that means is it's after subtracting something. In this case, net exports, which I'm going to show as NX for short, net exports equal total exports in an economy minus the total imports. Imports, remember, are goods and services that come from a foreign economy, from overseas. So from the firm's point of view, it produces enough to meet the demand of household consumptions in its own economy, the purchases it needs to make to invest in itself, the demand that comes from government purchases, and the demand that other economies have for its goods and services, minus any of the imports that are coming into the economy. Now, from the household position, how does it look? Well, households get income multiple ways. They get income in the sort of traditional way, which we call the amount that they get from their earnings, which is their wages, essentially. But households also get income by getting transfers from the government. It's the total amount of government assistance that households receive. And then households can't just spend or save all of that, right? Because they do owe taxes to the government. So we always have to subtract out taxes, which, if you recall from previous chapters, we're dealing with something called disposable income. That's the amount they actually have left to either save or spend after they pay for taxes. Now, what do they do with it? Well, they either spend it, which is what we call consumption, or they save it, meaning they send the money to financial institutions. And we're going to look at the financial institutions in just a second, but if you recall, financial institutions are going to do something with that money, okay? Now, let's look at this from the government's perspective. What does the government like to do? It buys stuff like planes and trains and automobiles and pencils and tissue boxes, but it also spends money on benefits, Social Security, welfare, health care, right? So those are the two ways that money leaves the government. How does money come into the government? Well, governments raise taxes so they get their tax revenue. But oftentimes, there's not enough tax revenue to cover all of the transfers and all of the government purchases, especially when a government's at war, because there's going to be a lot more purchases. So governments go ahead and they borrow. And where do they borrow from? They borrow from financial institutions. And where did those financial institutions get their money? They got it from household savings. Is this starting to make sense? So let's look at that financial sector. Two ways that financial sector spends money. It invests in the firms in the economy so that they can produce more output in the future. But the financial sector also helps finance the government's expenditures, which are in the form of government purchases and in the form of transfers, like benefits. Now, where does the financial sector get its money? Two different ways. From the private savings of households in its own economy, but also by borrowing from overseas. Lastly, let's look at those people who are overseas, because they seem to be kind of important. The foreign sector, we'll call it. Well, that whole borrowing from overseas or borrowing from abroad, that comes if our imports are greater than our exports. The way we figure out how much an economy is borrowing from overseas is to take total imports and subtract total exports. Remember, total imports are the total goods and services that are purchased from foreign economies, and exports are the total goods and services sold to the foreign economies. When exports are greater than imports, we say net exports is positive, and that means the country, your current economy, is actually lending to foreign economies. But when imports are greater than exports, we say net exports are negative, and that means the country is borrowing from foreign economies. So you now can see how many different sectors there are. There are households, there are firms, there is the government, there are financial institutions, and then there are everybody else in the world outside your home economy. And all of them play into each other to eventually say that total production in any one economy is going to equal consumption plus investment in the firms in that economy plus the value of all the government purchases plus the net exports. Now remember, net exports will be positive if the country exports more than it imports, and they will be negative, meaning it's borrowing from other countries, if imports are greater than exports. That is the sum of all of the flows of money in an economy that is linked to the rest of the world. Now, before we close, let's go back to that concept of real GDP, and let's remember what it's great at, which is it's a great indicator of the overall production in an economy. And since overall production always equals overall income, which equals overall spending, then real GDP is a great indicator of all of those things in an economy. But here's where it has limitations. It doesn't necessarily tell us about the individual economic welfare of the country. What if there are 100 million people in a country and it has lots and lots of GDP, but only 5 people benefit from the GDP? They're the only ones making any money. Well, one of the ways we can sort of look into how can real GDP somehow tell us something about individual economic welfare in the country, well, we can take that total GDP and we can divide it by the total population, and we come up with a figure called GDP per capita, or GDP per person. Capita is Latin for person. Real GDP also does not tell us about non-market transactions. Remember, not everything actually is bought and sold in a store or happens in some sort of market situation. It could be the result of bartering. I've done this a lot, and I'm sure you have too. Hey, listen, you like to make pies, and I really like to do accounting. How about I do your books and you make me pies? We also call that exchange of services. What about this? What if I make all my own food, and I grow all my own food, and I clean my own house, and I fix my own car? Well, I'm not purchasing any of those things in the market, which means I'm not accounting for them in GDP, which means I don't probably have the right information on real GDP to the extent that lots of people in an economy are doing a lot of things for themselves and not actually going into the market to get them. Lastly, a major limitation of real GDP is the fact that it in no way values leisure time, right? All it is the measure of total output, total production. What about the value of non-production? Real GDP can't tell us that. So we try to find some other indicators of what we call societal welfare. The first one we're going to touch on is unemployment rate, which you've already covered pretty well. And that's the total unemployed workers in an economy divided by the number of people who want to work. Not the total number of people in the economy, the total who want to work. Well, unemployment rate tells us how well production is actually getting towards the workers who want to be part of it. Now look at this time period that's circled for the unemployment rate in the United States. And notice somewhere between 1995 and 2010, we're seeing that the U.S. economy's unemployment rate is a little above 6% and stretches all the way up to probably just over 9%. Somewhere between 6 and 9%, though it drops as low as 4% in the year 2000. Now let's look at Argentina for the same period. In 1995, their unemployment rate is almost 17%. Now it dips as low as about 13%, but it never goes lower than that. Whereas the United States went as low as 4% in the year 2000. And by 2002, Argentina's unemployment rate is almost 20%. You notice we didn't see anything close to that in the U.S. economy. Not since 1940 have we even gone above 14%. So Argentina clearly, whatever its GDP is, Argentina clearly is not able to employ all the workers that want to be employed in that economy, and it doesn't do nearly as good a job at employing its workers as the United States does. Now, another indicator of societal welfare is the real wage rate. And that just says it's the nominal wages in an economy divided by the price level. Remember, price level is going to be measured by something called a CPI or perhaps the GDP deflator. Well, in the United States, we see that real wages from 1964 to 2010 were pretty steady, right around $8 almost all the time. However, nominal wages have been going up and up and up, and that would probably mean the reason that real wage has not actually been changing all that much is because of the price level. And if the price level has been increasing, which it has been, we call that inflation. Now, what are some other measures of societal welfare? Well, those are things like GDP per capita, which we already talked about. An infant mortality rate, that actually says how many infants die per 1,000 live births. You want that rate to be as low as possible, obviously. Life expectancy at birth, that tells us how long would any baby born in the current year be expected to live in that country, and we want that to be as high as possible. The adult literacy rate tells us of all the adults in the economy, how many of them are able to read in their own language, and we want that to be as high as possible. Secondary school enrollment is a similar thing. Now, just comparing 4 different countries, between 2002 and 2005, we see that the United States has the highest GDP per person or per capita, certainly much higher than Argentina. The infant mortality rate, interestingly, is lower in the United Kingdom and Greece than it is even in the United States. There are more babies dying per 1,000 live births in the United States than in Greece or the United Kingdom. However, many more are dying per 1,000 births in Argentina. The life expectancy at birth in the United States is not the highest. It's higher in the UK and actually in Greece. So apparently we're going to live a little longer if we go to Greece. In Argentina, though, it is a bit lower than it is in the United States. The adult literacy rate is the same in the UK and in the United States, though the secondary school enrollment is actually lower in the United States than it is in Britain. And it's almost exactly the same. The literacy rate is almost exactly the same between Greece and Argentina, though Greece clearly enrolls more students in secondary school than Argentina does. This concludes the videos for Chapter 18. If you finish the rest of the PowerPoint slides, you will discover some key terms and some key concepts for Cooper and John, Chapter 18.